Why do some cryptocurrencies skyrocket while others don't quite take off? Is diving into the world of cryptocurrencies a good idea? And if so, how should one go about it? You might wonder if there's some kind of secret formula that makes sense of the ups and downs in cryptocurrency trading. In this video, I'm going to dig into a statistical perspective on trading and buying cryptocurrencies. Whether you're new to crypto or an experienced trader, this video aims to shed some light on the statistical nature of the cryptocurrency trading landscape, offering insights that might just change the way you view your next investment. In the world of startups and venture capital, outliers drive the industry. But what does that really mean? It means that a tiny fraction of companies end up generating most of the growth, jobs and value. The reality is, while most startups go bust, a select few go on to achieve extraordinary success. This kind of uneven success story is best described by something called the power law. Normally, outcomes like public stock market increases or decreases and other measures like height or intelligence follow a normal distribution where most values cluster around the average. But for startups, outcomes follow the power law, where the majority might see failure or at best modest gains, but a handful of outliers achieve massive success. This concept is also very relevant to cryptocurrencies. Everyone's heard the stories of cryptocurrency making people millionaires basically overnight. However, is this really as common as it might sometimes seem? Or are these just the very few outliers everybody talks about? If we dive into the data of 12,000 different cryptocurrency, thanks to the free API solution provided by CoinGecko, we can gain further insight. Imagine tracking the price changes of all these cryptocurrencies from the moment they first appeared on CoinGecko up until today, March the 10th, 2024. By turning these changes into a probability distribution, which is basically a fancy way of showing how likely different outcomes are, something quite striking stands out. Most cryptocurrencies don't see much increase at all. In fact, a staggering 80% of all coins have actually dipped in value, which is the same as returning less than 1x and would have led to a loss if you invested from the get-go and held until now. Here you can see the remaining division of outcomes. Only 10% returns between 1x and 2x, 2.76% between 2x and 3x, and 1.43% between 3x and 4x. This means there is about 5.81% left which have returned above 4x, which is actually outside of the figure frame here. We can zoom out to get an even more nuanced look. Even though most outcomes are concentrated fairly close to 1x, the distribution have an extremely long tail where extreme outcomes actually do occur, however extremely rarely. Here it will get a bit technical, but yet really fascinating. The pattern of these outcomes, where most coins fail and only a few see outsized returns, is strikingly similar to the outcomes found in the startup and venture capital industry. As mentioned previously, this behavior fits what's called a power law distribution, and we can actually fit such a distribution to these outcomes. This means that while most cryptos won't make you rich overnight, a few outliers still have the potential to skyrocket. This pattern underpins the stories of sudden crypto millionaires, but it's also a reminder of how rare those cases actually are. The crucial takeaway isn't about proving whether crypto outcomes strictly follow a power law. I would actually not vouch for this distribution to be a perfect and significant fit. What really matters is recognizing the extreme variability, which gives the crypto landscape some unique characteristics worth paying attention to. In skewed distributions, there's often a significant difference between the mean, often also called the average, and the median. if we revisit basic statistics, the mean is calculated by adding up all the values and dividing by how many values there are, giving us 10. But this mean is heavily skewed by the outlier value of 60, which makes the mean over 3 times larger than any other number in the distribution. The mean is therefore not accurately reflecting the most common values in the distribution. The median, however, represents the middle value when all the numbers are sorted and is 2 in this case. This offers a much closer reflection of what one typically finds in this distribution. This difference between the median and mean is very important when understanding investment outcomes in cryptocurrencies. Since crypto outcomes also follow a highly skewed distribution, if you invest in a single cryptocurrency, you are much more likely to get a return closer to the median rather than the mean. We can bring our discussion to life and visualize the actual difference between the mean and the median outcomes in our cryptocurrency dataset. From the moment the coins were listed until March the 10th, 2024, which is the day I downloaded the data, the mean return across all cryptocurrencies is an impressive 2.93 times the initial investment. If you had spread your investment evenly across the entire crypto market from the date each coin was listed on CoinGecko till today, you would have nearly tripled your money, which is pretty good. However, things change when we consider the median return, which stands at a mere 0.19x. This illustrates that randomly choosing a single coin from the market is most likely going to result in losing about 81% of your investment. Pushing our analysis further, let's consider the theoretical maximum return one can get, which means if one sold at the highest price each coin have ever reached. Under this ideal scenario, an investment spread across all available coins would have yielded a return of 91.53x. Yet, choosing a single coin at random and selling at its peak is more likely to return something close to 1.58x. For everybody navigating the crypto markets, this analysis highlights a crucial point. Statistically speaking, aiming for the market's mean return is more advantageous than individual picking. But how exactly can one achieve this? In fact, getting returns closer to the mean can be as simple as diversifying your investments. The more cryptocurrencies you invest in, the higher your chances of capturing the extreme outliers. We can visualize this through a simulation experiment conducted 10,000 times where portfolios vary from choosing just one coin to a portfolio investing in 1,000 coins. We pick completely random times in a random coin's life cycles, make the investments, and then look at the theoretical maximum returns which would have been achieved by selling the coins at their peak price. The y-axis in the figure show the multiple on invested capital, and the x-axis show the number of coins or trades taken. The green area indicates when 95% of the simulation outcomes fall, and the red area marks where 5% of the outcomes fall. The median of all simulations, represented by the blue line, closely mirrors the gains one is most likely to get for a given portfolio size. Another fact about the median is that 50% of the simulated outcomes are below it and 50% are above it for each portfolio size. So even though some of the outcomes from the simulation obtain very high multiples, indicated by the green area stretching far into the 30s for basically all portfolio sizes, the outcomes are spread much more thinly above the median line than below it. As the figures show, just buying a single coin leads to a median outcome of just above 1x, while buying 1,000 coins leads to a median portfolio outcome closer to 7x. This empirical evidence highlights a crucial insight. Diversifying your crypto investments not only mitigates risk, it also statistically enhances your odds of achieving better returns, which are closer to the market's mean. In essence, from a statistical standpoint, diversification in the cryptocurrency market is likely to enhance your returns. This is because, much like in the startup and venture capital industry, success hinges on capturing the rare but extreme outliers, and diversification boosts your chances of doing just that. However, it's important to remember that this analysis is rooted in statistics and aggregate data, which gives no certainty about individual outcomes. Moreover, it's well known that not all cryptocurrencies are created equal. Bitcoin, for example, operates on fundamentally different drivers than, let's say, the latest meme coin. Thus, investment decisions should be made with careful due diligence, recognizing that some coins may hold fundamentally stronger future prospects than others. It must also be stressed that historical performance does not guarantee future success. This is vividly illustrated by the cautionary tale known as the turkey problem. Imagine a turkey that has been well fed and cared for its entire life. Surely, based solely on historical data, this turkey believes in a virtuous future. However, as you probably have guessed, the turkey has been nourished for the sole purpose of eventual slaughter. Interestingly, from the turkey's perspective, by judging its future only by extrapolating from its past, the turkey will be most certain of a wholesome future on the day of the slaughter itself, since this day will have the longest history of good prior days. The turkey problem clearly highlights the fallacy of relying solely on historical data for future predictions, especially in domains of great uncertainty such as economics. Fluctuations in the US dollar's value, potential economic bubbles, and regulatory changes in the cryptocurrency landscape are all unpredictable elements that could steer future outcomes away from past trends. Well, I hope this video helps you navigate the somewhat complex but still exciting world of cryptocurrencies with a bit more statistical savvy and caution. If you found this useful, we have a dedicated Discord channel where we have developed a neural network-driven crypto prediction model named Meteor Marshmallow Machine, which is free to use. We are also very interested in engaging the community for further development of this algorithm. Thanks for watching.